Ladies and gentlemen, all the way from Houston, Texas, please welcome Mark Eramo. Come on up.
Thank you, Jalen. Appreciate that introduction. And good morning to everybody. Let me start by congratulating Gail and the Heartland Association team for really put together a fantastic event, and congratulate all of you. I spoke in 2017. I think the number was 600 to 700, and so I understand we're 1,000 plus in here today. And so thank you also for inviting IHS Markit to come share our thoughts on the state of the global chemical industry in terms of where we see things today and where they're going. I'll also make the comment that I am up from Houston. I did go through Beijing to get here, not because my travel planners don't know what they're doing, but I had some business to do over there. I'll also point out, though, that it's 23 Celsius in Houston this week, and so, but I always say you've got to come up to Calgary or Edmonton. You got to come up to Alberta at least a couple times a year in the wintertime just to show you the love, and so happy to be here to show you the love. All right, so I'm going to talk about the state of the global chemical industry, and it says in the subtitle there, positioning for what comes next in the global industry as economic headwinds strengthen. So, just the industry has been on a tremendous run of profitability, say over the last 3 to 4 years. We are in what we call an extended upcycle, and that extended upcycle brings planning for reinvestment, and Alberta is a great example of that. But there are headwinds out there, as we heard on the economist speech from an economic standpoint, because economic growth and growth in the chemical industry go hand in hand. And so there are concerns, but there is also tremendous momentum. And so I'll try to make the case that this upcycle still has some life left in it. There are some concerns as we get into the 2020. And then towards the latter part, we'll talk about some strategic issues that wherever you are in the world, you need to take note of some changes that are certainly taking place in the industry. What I call my perspective slide, where does the petrochemical industry sit in the grand scheme of getting from a barrel of crude oil, a cubic of gas, a ton of coal, and then convert it into consumer products from around the world. And quite frankly, the billions of dollars of investment that are required to go down that value chain. We like to say that energy and chemicals enable modern living. We enjoy the lives that we live today because of the energy and the chemical industry. But that comes with its challenges, and it comes with its benefits in terms of the importance and the ability to bring economic development, to bring jobs to different locations and countries around the world. And as you travel the world, whether, and I'll mention whether in Saudi Arabia, as we were joined by colleagues here from Saudi Arabia, or in Europe, or in Latin America, or Houston, or North America, or from Beijing down to Singapore, companies and countries look at this value chain and are making decisions to say, how far along that value chain do we want to invest in order to have the economic development and benefits that come along with that? And that is, the decision process and the activity that is happening all over the world in order to enable modern living and benefit various countries. Now, I will also point out that never, and I've been in the industry now 30 plus years, and never before have I seen such scrutiny on the challenge to these industries to say, yes, there's economic benefit that comes with this investment in this value chain. But please take note of the fact that from a societal standpoint and an environmental standpoint, we expect you to keep our environment clean. We expect you to be good stewards of the environment. And this subject or this topic or the title of sustainability has been growing and growing in importance over the course of the last decade, to where now there is a very laser focus by the industry on sustainability, and it's more than just about plastics. It is about carbon, it is about climate change, it is about water, it is about continuing to improve the communities, the environment that we operate in. And all of these challenges have to be achieved in a very highly competitive and global marketplace. So this is not easy. but this is the industry that can certainly rise to the challenge as it has over a number of decades as the industry has developed. And we are in a region, will go ahead and point out, I will say we are in a region of the world, or this is a region of the world, Alberta as a whole, that I think does this balancing very, very well. I'll say is one of the best at doing that from the very, very beginnings back in the 80s from a chemical industry perspective to where you are now and where you're headed in the future. So again, as I said, I'm going to spend a brief time talking about the state of the industry in terms of where we see things on a short-term basis, and then I'm going to really try to key you into some key trends that we believe, from an IHS Markit perspective, are going to impact and potentially even begin to change the face of the industry of refining and chemicals as you come into the 2020s. If you're not familiar with IHS Markit, I don't have a marketing slide in here, and by the way, my bonus is directly related to the number of things that I can sell to people. So from that perspective, I don't have a marketing slide, but IHS Markit is a combination of a number of entities with data and insights and capabilities, and especially in this energy and natural resources market, from what's happening in energy resources below the ground to what happens to processing those materials and creating chemicals and fine chemicals and plastics and polymers and fibers and all of the above. And so we have a long history, and again, just thanks for the opportunity to share our thoughts on what's happening in the industry. A quick comment on our global economic outlook, only so that you understand the basis that we're coming from when I show you our forecast of demand growth, because the two things go hand in hand in terms of the level of growth of base chemicals and plastics relative to the economic outlook. I like this money tornado because that's what things kind of feel like over the last 12 months or so, especially if you're in the United States. There's a lot of money being made. There are some winners and losers on different sides. There are some pitfalls or some headwinds growing out there. But again, in terms of the overall economic outlook, we think there's momentum. We believe there's momentum, even though there are some danger signs in terms of a slowdown in the future. Just a quick snapshot of really the bottom line. So this is world economic growth, world GDP growth, highlighted for the world there at the top, and then some select countries down below. So we're estimating 3.2% was the growth in 2018. We still think 2019 can come in at 3% from a global perspective. These are big numbers. And again, if you think of if the world is going to grow at 3%, and if all of these major countries and regions are going to be in positive economic growth, base chemicals and plastics grow at some multiple of GDP, anywhere from 1 to 2 times GDP, depending on the part of the world or the segment that we're talking about. So when you can see 5% growth, 8% growth, 7% growth in these big markets, if the world is growing, then you're going to need base chemicals and plastics in order to meet the ongoing demands of durable and non-durable goods that you and I consume every day. I've highlighted in red, I think, a couple of points to stay very close attention to. We do have a decelerating U.S. economy. Actually, that 2% in the U.S., having been close to 3% just last year, is of concern and of interest in terms of as the benefits of the tax policy changes in the U.S. start to wear off, and the deregulation that's occurred. And we'll see what happens over the next 2 years, as we probably have a lot of gridlock in the U.S. government going forward. I've highlighted the 1.1 on the United Kingdom. We think that's a Brexit implication. And then you also see China starting to decelerate as well. And on the China numbers, I always just like to put it on perspective. This is an economy that's 2/3 the size of the United States, growing at 6%. So again, it's tremendous growth. But yes, they are decelerating and they are changing. And we'll talk a little bit about China from a petrochemical perspective. But again, the message here is still on a base planning case, still strong fundamental growth as we look at 2019. Things starting to come off a bit in 2020 from an economic growth standpoint. The energy impact on chemicals, rising crude oil prices solidify a North American gas-based advantage, threaten continued strong demand growth. And of course, oil price volatility has certainly been a subject of the near term, and that creates pause and concern in the short-term marketplace. But in general, a higher crude price, if you look at what we have as a base of energy in North America, tends to be a benefit or an advantage from a North American perspective. And this is a simple way that I like to look at it, is the black line is Brent crude oil read against the left axis, the bars below or U.S. Gulf Coast natural gas read against the right-hand axis. And as this spread increases versus what occurred in the early 2000s, or even if I pulled this graph back to the 1990s, as that spread increases, a couple things are happening. Number one, as crude oil price rises, the majority of base chemicals and plastics are really derived from crude oil feedstocks, and therefore the prices for those base chemicals and plastics will rise with crude oil. And if you're sitting on a natural gas-based feedstock in petrochemicals, and your feedstock prices aren't changing as crude oil price rises, then that accrues a benefit to you. You basically are in a seller's position to allow the market to set the prices, and you take advantage of that spread. And that spread, as you see here, is part of what has been creating this phenomena of bringing reinvestment back to North America in the base chemicals and plastics arena. And our base planning forecast says that spread isn't as high as it was back in the 2012, 2013 time period. We don't believe $100 per barrel crude is sustainable, but somewhere in this $60 to $70 range, Brent, that we have as a base planning case, and noting you will get lots of volatility on a quarterly, monthly basis around that sets up a good scenario, if you will, for the North American base in terms of investment. Get tons of debate on where the crude price is and where it might go. Very little debate as I travel around the world on that gas number, because it's generally recognized that North America is got plenty of gas. There's an old colleague of mine who likes to say the world is round because it's full of gas, and we have access to a lot of that here in North America. There is little debate over lower and stable prices for North American gas. And again, that sets up, from a hydrocarbon cost standpoint, to make these base chemicals and plastics an inherent advantage from a North American perspective. And it's much more complex than just the cost of hydrocarbon, but as a starting point, that's a good place to be and a good position to be in. And so you can see in our forecast, we're suggesting you will continue to have capital flowing into the North American region as a result of this assumption on energy. Just a little bit of an example is what happens to the cost of making base chemicals as you go through an energy cycle of high and low crude oil prices. 2013 production cost of a variety of base chemicals, methanol, the ECU represents chlor-alkali, ethylene, and propylene. This is a 2013 basis, $110 crude. I'm looking at from the Middle East, North America, South America, West Europe, and there you see North Asia. So you can see that the production cost on ethylene and propylene as high as $1,200 per ton and $100 per barrel crude. And again, look at Middle East and in North America on their production costs for, say, ethylene and propylene, a distinct advantage in terms of those cost differentials versus the price setters. Obviously, in a lower crude oil environment, this is 2016 numbers, $40 crude, you get a much flatter world in terms of the competitiveness of the regions, and it does create a different dynamic. And if you felt that crude was going to be $40 long term, you would start to take different decisions in terms of your investment locations and technologies based on the economics that you see here, again, in these different markets and in these different regions of the world. Not the only driver, again, in terms of why you invest in a location, but certainly a key part of the driver and a key part of the competitiveness. So I thought I'd show you how the energy cycle can impact and really brackets the cost of production and sets up either an advantage or a disadvantage depending on where these assets are being built. And you'll just note it really a close scrutiny of the numbers that I have here, and I realize from your angle you can't quite see the detail here, but North America, second to the Middle East, has really a very competitive advantage even at a high end, or certainly at a high crude oil price and even at a low crude oil price, there's still an inherent advantage that's sustained. And so from a capacity standpoint, we like to say that there was a build cycle disruption seen in 2020, 2021 as the industry awaits FIDs on the next wave of capacity. And this is certainly the case in North America. And you might say, what do you mean build cycle disruption for 2020 and 2021, Mark? This is, the early part of 2019. Well, most of these projects, as we heard earlier on the PDH polypropylene unit, that it takes many years, even once you get to FID, you're probably talking 4 to 5 years from startup. So if you go back to 2015, if you go back to 2014, 2015, in the severe volatility around crude oil price, the implications on the economy, we feel there was a pause in the approval of many projects around the world. And so as we move into this period of 19, 20, and 21, we're not seeing as many new projects starting up because 4 or 5 years ago, there was a delay on FIDs because boards of directors around the world were saying, wait a minute, crude went from 100 to 40, what if, and asking all kinds of questions about the economy, let alone the geopolitics at the time that was going on. And of course, none of this uncertainty ever really stops, but we certainly are into a wave now of higher profitability where we are now seeing the FIDs occur. This schematic here, this map here is just showing you, the current, if you will, base chemical capacity. You see the chemicals listed there in the lower left-hand corner. In 2018, this is base chemical capacity around the world that exceeds 650 million metric tons. And I really like to use this slide to say, okay, so here's a check for $10 billion, and you look at these different value chains from aromatics to olefins to methanol to chlor-alkali. Where are you going to build your next asset, or where would you like to build your next asset? Now, you guys don't have to answer that. I know where you want it built. But what are you competing against? And so from an Alberta perspective, you're competing against Appalachia, you're competing against U.S. Gulf Coast, you're competing to some degree against what may be happening in Brazil as they develop pre-salt and get energy production back underway in Brazil. You're competing against possibly shale plays that are being developed inherently in Argentina, known as the Vaca Muerta, which is a good, rich shale play where companies are looking at. So these are the different sources of competition, if you will, for the capital. And I will even argue you're competing with the Middle East, you're competing with India, you're competing with China, you're competing even with Europe, where we're now talking about building assets. So the question is what are all the different factors that brings that capital to Alberta that says, why do I want to build a PDH polypropylene unit here, and how can I compete? And can I sustainably compete? And what else can I build here in this range of base chemicals and plastics and derivatives if in fact I've got an inherent advantage? What are you looking for, or what I'm looking for if I'm going to invest that $10 to $20 billion is a secure energy and feedstock advantage. I want to build with the latest technology and world scale. I want to invest with proximity to the market. So there's a flag from an Alberta standpoint, is you don't consume a lot of these products in country, right? They've got to go someplace. So market access. And I want to build to leverage an upstream or downstream integrated position. And there's a big check mark from Alberta from that perspective. I show this photo of the Braskem-Idesa ethylene plant that started up in 2016 because to me, it marks the end of a hiatus on building in North America. So prior to this asset, this is a 1 million ton purity ethylene plant with 1 million tons of polyethylene. Prior to this asset being built and starting up in Mexico, the previous unit was built in 2003, and that was actually a BASF Total Fina integrated refinery and naphtha cracker in Port Arthur, Texas. So it was a pretty 13-year hiatus before this asset was built. And since then, right, North America is back off to the races in terms of investing in petrochemicals. I also wanted to include a photo of this asset that's under construction, which is the Shell Chemical site in Monaca, Pennsylvania, which is being built based on low-cost ethane. It will also be 1 million plus tons of ethylene, polyethylene, and likely even ethylene glycol. I show this because paradigms change, dynamics change, market dynamics change. And so 10 years ago, 15 years ago, 20 years ago, if somebody was said, go build an asset in Monaca, Pennsylvania, they'd have said, you're crazy, there's no way you won't do it. Okay, but there is now a situation because of shale gas and in the development of shale and what it's bringing, and obviously the strategy from a Shell Corporation standpoint that has advanced this project, and it is happening, it is underway. And so markets change, paradigms change, and we see this cycle continue. And one of the challenges is how do you stay ahead of that and say what's coming next in terms of changes in the build cycle in the industry. What have countries around the world been doing in terms of their base chemical capacity? You see a cluster of countries down below, which we'll take a closer look at in a second. But here's the United States in terms of where we've been and where we're going. You see the decline that actually occurred in the early 2000s, and now, maybe by 2025, 2026, if FIDs continue to roll through, we'll be over 100 million metric tons of these different base chemicals. China, of course, is the most startling one in terms of its acceleration and its investment in this sector, which we'll talk about shortly as part of one of those areas of the 2020s that you need to keep an eye on. If we expand the other countries and see just what's been going on in Canada, Saudi Arabia, South Korea, India, Singapore, Iran, other countries are continuing to invest at certain degrees and at certain levels based on, again, those various advantages or disadvantages that they believe that they have. And so again, you've got this whole level of activity, and the challenge is always based on where I put my asset, how am I going to compete in my space, in my region, in my value chain, based on what's going on a global basis. I do not expect you to read this list of assets. My point here is that there is a new wave of ethylene expansions that are underway in China. So China spent the last 5, 6, 7 years building a lot of coal-based technology olefins, which are very expensive, very environmentally unfriendly from a carbon standpoint, and huge water consumers. And so the government has shifted gears and has now enabled, both from state-run and private-run companies, to enable a whole new series of investments in ethylene capacity that is now based on LPG and naphtha, and there's also some ethane consideration that is underway. So again, it's just to make the point that China has shifted gears in terms of its investment strategy from this base chemical standpoint. We're seeing them going back to more conventional naphtha, LPG, even potentially ethane cracking in terms of their build. And of course, the scale of what's happening here is phenomenal. There's another side note on China is that they hold an inherent capital advantage where a lot of these assets can be built, if you compare to the U.S. Gulf Coast, maybe at 0.65 to 0.5. So in some cases, half the cost of building a like asset on the U.S. Gulf Coast. Now, there's a whole lot of detail to have around that discussion in terms of like for like, but the point is there's an inherent advantage for putting your capital in China, even from a multinational company standpoint. That is another form of competition, if you will, in terms of attracting capital. So from a supply and demand standpoint, again, we just kind of roll up all of our assumptions on who's building and where. The demand growth based on the economy. To give you a little bit further insight into what we're assuming on demand growth. So the various colored bars represent 10-year periods, if you will, roughly 10-year periods for the different base chemicals and the rate of growth relative to GDP growth. So if you look to the far left of the graph, just to get you an understanding of what you're looking at here, under ethylene, that green bar from 1990 to 1999, ethylene grew on average, global ethylene grew on average at 2 times the rate of GDP. So that's kind of how you interpret this graphic, and you can kind of see in the recent years it's been slightly above GDP and now trending even higher. And there's a whole lot of detailed discussion going on there. Propylene, because of polypropylene, is actually growing at an even higher multiple from a standpoint of GDP growth. So these are the assumptions we're making that basically lead to a demand growth. So these are the volumetric numbers we're assuming in our analysis. So again, if you look at ethylene, the green bar represents our view of 2018 world growth of ethylene on a global basis. It's over 7.5 million metric tons. I had to go double check with our olefins guys 3 times because I spent a lot of time studying the ethylene market, and I've never seen the ethylene market grow, say, more than 6 million tons. I said, are we sure? And there are a lot of statistics that still need to come in from some of the Asian countries, but it's going to be strong. It's been a strong number. And then if you look at the blue bars, that's our average growth going forward from 19 to 2023. It's strong and robust growth from an ethylene and propylene perspective especially. The green boxes at the bottom, just to give you a perspective of the total size of the market in 2018. So it's ethylene being a global market of 160 million metric tons in 2018 is our estimate. And again, growing at, on average, maybe 6 million tons per year, which is significant, especially if you consider a world-scale ethylene cracker is 1.5 million tons. So do the math. How many steam crackers do you have to be building to keep up with that pace of growth? Okay. Now, give me an economic recession in those numbers, right, and we're going to pull them down. So there is some sensitivity analysis to be done around that. But on the base planning cases, we're very, very strong as we head into the 2020s. On the left-hand side, nameplate operating rates for the global assets of ethylene, propylene, and chlor-alkali. I've included chlor-alkali in here because some interesting things are happening there. But focus on the blue line, the ethylene line, which is hovering at or above 90% for a sustained period of time. I mean, that's essentially sold out from an ethylene market perspective. It says you need more product. You see the strength on the propylene side as well beginning to increase. Propylene's a little bit more difficult animal to get at because propylene comes from steam crackers, it comes from refineries, and now it comes from on-purpose units. If we put the on-purpose unit utilizations on there, they'd be slightly higher. But the point is that they are maintaining a lot of strength there. Right-hand side is just another calculation to say if your cumulative surplus capacity hovers around 10% in these markets, you basically have a fundamentally strong market, 10% or lower. And so again, by different measures, we say we have some strength, we believe, that continues into the early part of the decades. I've thrown in a couple of base trade slides just to make a point here. Apologies, the time scale is up against the axis instead of down below so you can see it properly. But this goes from 1990 to 2025. The point here is think of this as an index that says for the regions and the countries on top, or the regions on top, which is North America and Middle East, those are net exporters of ethylene in the form of derivatives or ethylene as a monomer. The regions down below are net importers. And so what you see here is a trend in ethylene, which is build low cost and ship to the rest of the world. And so North America and the Middle East, by our projections, will continue to be the primary locations to build in these low-cost regions and then supply the derivatives ethylene to the rest of the world. And it's because of the inherent nature and the amount of investment that's required and the relative growth that's occurring in the ethylene market. And so again, you can see the green section is continuing to increase from a North American perspective. You also note if you go back to 1990, that number is less than 5 million tons of traded product to now it will approach more than 40 million tons of traded projects. So the ethylene logistics around the ethylene molecule is just as important as it is in terms of where you're going to put the asset. I've shifted over to propylene here, same analysis. The regions on top are net exporters of propylene molecules in forms of derivatives as well as monomer. The down below are the net importers. And just notice the scale change. And also notice that the spread really kind of has stabilized at about 5 million tons for a number of years. And this represents the onset of on-purpose technologies. PDH units, for example, the ability to build the propylene that you need for the derivative that you need in the location that you want it. Right? And this is happening all over the world. And so the propylene market has been acting slightly different because the on-purpose capability is a reality, is very much a reality of the propylene market. Hence, we're seeing PDH units being built in North America, both on the U.S. Gulf Coast as well now in Canada. So from an industry earnings and market sentiment standpoint, again, think of this as an index in dollars per ton across all of our models on a weighted average basis across the regions to try to give you a feel for, just how profitable is the industry. And the profitability that goes, if you go back to 1990 and through the forecast time period, that when those profit levels sink below zero, or when they collapse, those are associated with economic downturns. That's why I said, if you want to put an economic downturn in your forecast in 2020 or 2021, let alone the supply-demand dynamics that are out there, then you're going to see a collapse in industry profitability. But this leads us to say we are in this period of extended profitability for the industry. Yes, there will be some volatility. It may not be as good as, say, we're suggesting right now for 2020 or 2021, depending on a number of factors. But overall, we think there's tremendous momentum. If the economy stays strong at 3%, close to 3%, even 2.9%, the assets that are on the ground trying to meet that demand growth are such that they have to run at very high rates, that we think the profitability stays fairly high for the short-term future from an industry perspective. So that profitability, as I said earlier, leads to reinvestment discussions and planning discussions. I showed you the detailed list on China, and we could go around the world, and again, whether you looked at the Middle East, even Europe now, and I say even Europe now because there's this thought that Europe is high cost, they're not going to build grassroots assets anymore, but those discussions are underway. Across the Americas, South Asia, India, China, North Asia, lots of planning discussions underway to bring new petrochemical assets. And so I'll take my last 11 minutes here, 12 minutes, and I'm going to talk about key industry trends to think about that may start to change the face of the industry during the 2020s. And number one is what we say is the next phase in the evolution of refinery and petrochemical integration. Essentially, higher fuel efficiency standards as well as increased use of EVs are creating a forecast of slowing or even declining rate in the demand growth for refined products. So the black line there represents our view of refined product demand growth. This is demand growth, 2010 out to our forecast for 2020. And the point here is that black line starts to turn over at some point towards the end of the 2020s or in the early 2030s. And I'll show you why we're saying that in just a moment. The green line is base chemical demand growth, which has this steady level of increase, 4.5% per year, depending on where you want to put your economic growth. And so if I'm a national oil company, a big refining company, and I have these assets in the ground all around the world, I'm asking myself, if refined product growth is going to slow, can I turn my asset and point it more towards chemicals? Because that will continue to grow. World population is going to grow. We're going to need durable and non-durable goods. Should I point more of my asset towards that base? And that creates this discussion about refinery and petchem integration, which isn't new. We've had refinery petchem integration for decades in the industry, but we're now talking about a slightly different dynamic, and I'll get to that argument. So a little bit of explanation as to why that black line's turning over. So global light-duty vehicle gasoline and diesel demand growth is the brown line as it extends. If you just took fuel efficiency today and didn't consider any electric vehicles, that's where that demand growth would go in the future. If you bring in increased and rising fuel efficiency standards, as is occurring around the world, that's where you get to the green line on that growth. And then now let's bring in at least the IHS assumptions for the penetration of electric vehicles, and now you can start to turn things over a little bit. So depending on where you want to draw lines on your analysis and where you think fuel efficiency standards are and will go and what you think will happen on electric vehicles, I think there is consensus that this number has the potential to start to bend over. And here's a little bit more detail on that on a study that we did with our automotive, energy, and chemicals team that basically just tried to say if you look at global light-duty vehicle sales by drivetrain from a base planning case, what will happen in terms of gasoline, diesel, and then a whole variety of electric-type vehicles that are out there. And if gasoline efficiency standards go from 19 to about 26 miles per gallon. So this is what's underneath that, and this is what's leading to this discussion about refinery petchem integration. And again, this isn't new. You can go around the world and you can sit and talk to companies who have a petrochemical plant sitting next to a refinery plant with all of these different interactions and synergies that take place. So what's changing in the future? Because that typical average plant that I'm talking about that's been around for years may have taken about 8% of the output of that refinery and dedicated it to chemicals through naphtha being cracked, right? And then you have Petro Rabigh, right, which is a joint venture between Aramco and Sumitomo, right, which has taken it to another level, 17, say 20%, in terms of the petrochemicals that would come from there. And then you look at a Chinese refinery and petrochemical integrated complex that's focused on maximizing paraxylene production, and that's going to take the yield to 42%, 42 to 50%, somewhere in that range. This asset will produce 4 million tons of paraxylene because that's what the owners want. It's an integration play on polyester. And then there is an announcement by Aramco that's in the press that says that we're looking at technology that we might want to go to 75+% conversion. So it's these refining assets being repurposed, if you will, I'll use that word, to say let's maximize chemical production and de-emphasize fuels production. Because, back to the original graphic, we believe refined product demand growth is going to begin to slow. And again, I want to emphasize demand growth. It doesn't mean we're going to stop making refined products. It's about the growth that's being projected for the future. The Aramco project is new technology that still has a lot to be seen in terms of what is actually developed. The other three areas represent existing technologies that are happening today, but it's a reconfiguration of the design between refinery and petchems to maximize petrochemical production. So an important aspect to look at for the future, and we're talking about $20+ billion investment here in terms of these assets, because the biggest change that this brings, especially that Aramco example there, is scale. You're talking about a single site that maybe produces 5, 6, 7 million tons of ethylene, not 1.5 million tons of ethylene. So to me, it says if this happens, it changes the build cycle. You have to think differently about how many assets you add in the future, depending on how many of these type assets will be added in the future. Okay, China, and it almost seems redundant to say that China, is a critical issue to consider for the 2020s. It's almost like duh, But, one, just to reemphasize the unbelievable scale that they've achieved in a very short period of time. Think about the video of the splitter, working its way through Edmonton, right, for an asset that's 500,000 tons of propylene, let alone an industry that has gone from less than 25 million tons and will now push 200 million tons of capacity. So think about the activity that's taking place in all these cities and these parks across China consistently over a long period of time in terms of the acceleration of their growth. And so regardless of the region or the value chain that you're in, we're saying you've got to take note of what's happening in China from a standpoint of the changes that are underway. They're going through economic transition. They have become very strict in terms of environmental protection, I should say, which actually is forcing smaller, older environmental assets to shut down. There's some supply chain interruption that's going on there. The balance of chemical company ownership of private versus state-owned. By 2025, or by the end of this time period, about 50% of that capacity, we believe, will be under some form of private or provincial ownership. Why do I care? Because it changes incentives. It changes the attitude towards I'm building to create infrastructure and jobs to I'm building for return on investment. Therefore, it changes behavior in the marketplace. That's our view. That's our take on what that means. Self-sufficiency objectives. China will go from 60% to almost 90% self-sufficient on propylene, and so that changes the trade dynamic. That's why I showed you those trade graphs earlier. As they change the amount that they build for themselves, it changes the amount of trade that occurs within the country. Technology development, continues underway. They've not given up on coal chemistry. They continue to push forward with coal chemistry. I talked about the crude oil to chemicals technology, the paraxylene unit that's being built, but the technology advances continue. I talked about the significant capital cost expansion, and then the international trade ambitions. The One Belt, One Road initiative is very, very real in terms of where they are buying assets around the world in order to also be able to be at some point a major provider of goods to the world, and essentially possibly even have the RMB recognized as a major trading currency versus the US dollar. All of these are important things to understand in your space relative to China. Not lastly, second to last, sustainability focus has turned to plastic. And I'm not going to go through all the bullet points here. There's no doubt, no question about it, that during 2018, there became a laser focus by major media and governments and people, online, social media, whatever media you want to pick, about the issue of plastics waste in the industry or in our environment. And there is no doubt that the industry is now taking significant steps in order to address this issue. When I say the industry, I mean all the way back to the petrochemical producers who make the plastic resins and sell it or trade it, the companies that are involved in the logistics of moving this product around the world, to the companies that are making the semi-finished or the finished goods, durable and non-durable, to the brand owners who are now selling their things to you and I in the grocery stores or in the retail stores. We have their attention, I should say, in terms of this issue of plastics waste. And what's important here, from my perspective of being a chemicals analyst for almost 22 years now, is this narrative needs to be about plastics waste, because I go back to the original comment, right? This industry enables modern living, so you don't want to backtrack on that. And I will even say that plastic solutions are a better solution from a carbon footprint standpoint than maybe some of the alternatives. But that issue of carbon in the sustainability discussion is it's not been lost, but it's been a little quieter relative to plastics, I'd say, over the last 12 to 18 months. And it's important that the industry brings this point forward in terms of the importance of plastics. But we cannot ignore a real problem. The plastics in the ocean and on these beaches, isn't bad science by some environmental group that doesn't know what they're talking about. It's real, and it needs to be fixed. This past week, if you saw coming out of the U.S., or I think on a global basis, an alliance to eliminate plastic waste, which is a group of 30-plus companies, led by the CEO of Procter & Gamble, and includes, base chemical companies from around the world, and encouraging others to get involved, and essentially offering up to, $1.5 billion of investment for solutions at the local level, at the technology level, at a variety of levels to try to get our arms around how do you collect this stuff, how do you keep it out of our oceans, and then what do you do with it once you have it, right? From repurposing it back into a monomer to converting it to a BTU or making it into some other durable or non-durable good. These are the kinds of activities that are underway. This will change the shape of the industry in the 2020s. In our opinion, there's absolutely no doubt about it, because in the meantime, you have single-use application bans being implemented all over the world. The marine waste has the attention of the public. Circular economy is very, very real and being discussed no matter where you go in the world. Self-imposed corporate bans. A&W, last time I was up here, came out and said we're eliminating straws, and I don't know if there's other products that they said they were going to eliminate from their stores. And so, again, are these the right solutions, or are these the right decisions relative to the benefits of plastics? But the plastics waste issue has to and will be addressed. In our analysis, so if I take you back towards, okay, so from a social perspective, I get it, I understand we need to be more aware, and I think we've created significant awareness. Okay, but now I'm getting ready to start up a 500,000-ton polypropylene unit. What should I be thinking about? So we've done some work that says, as you go forward on this issue, from a post-consumer waste standpoint, in terms of reusing the plastic in another application, or from the potential of being totally displaced, like maybe we'll never see plastic straws again in the future, what does that mean to demand growth going forward when you look at the issues from that standpoint? So we've taken a stab at it, and the green line there is just for illustrative purposes, but the black line represents, from a global basis, our trend line forecast for demand growth of polyethylene demand going forward. And so we're doing analysis value chain by value chain, commodity plastic by commodity plastic, end use by end use, and asking those two questions. Can you use this and recycle, or can it be displaced completely, and if so, replaced with what? The point is, it will change the demand growth trajectory, and that's an important thing to get your arms around. Now, there's another argument to this that says that, as these new applications develop, you might also get some stimulation in demand growth as well. So there's upside and downside to that black line, and which is the importance in any base planning case. What are the potentials and the opportunities for downside risk? What are the potential and opportunities for upside risks? Plastic sustainability is clearly a downside risk that needs to be understood. Absolutely, no doubt. Last point that I'll make, and the numbers are blinking red at me, so I'm going to bring up a number of things here. And that is, as we move forward, this graphic here is showing you, for ethylene feedstock over 5-year increments, the change in the feedstock used to make that increment of ethylene. So from 2000 to 2005, the first bar, almost 15 million tons of incremental ethylene was produced predominantly from naphtha, a little bit from ethane, and then the rest LPG, right? And so you can see that trend going forward. 2015, naphtha actually contracted. But as we go forward, you see us bringing naphtha back into the equation, right? We need naphtha to close the balances from our long-term perspectives on the ethylene market. You can't supply the world demand growth of 6-7 million metric tons demand completely from North America and Middle Eastern low-cost ethane. You have to bring in other feedstocks, and this is what we're showing here. Another view of that here is this is just the total volumetric view of our ethylene production over time in terms of the amount of naphthas and ethane. The other point I make here is that the ethylene for the foreseeable future, that I'm calling 2030 in this graph anyway, is dominated by hydrocarbons. It's dominated by naphthas, ethanes, propanes, butanes, condensates. And then those little slices at the very, very top are your coal-based chemistries, your on-base chemistries from an ethylene market standpoint. So unless some other big invention occurs in the next 10 years, this is what we'll be faced with. So I bring you back to the discussion about crude oil pricing. Crude oil pricing will drive a lot from an ethylene market perspective. Now, on the propylene side of the equation, it's been a different story. And so this graphic is showing you propylene production by technology. The first layer is a steam cracker, the green, the gray is refinery, and then that turquoise is on purpose. And that's what's been growing, and we say it reaches or starts to approach about 30%. It's predominantly PDH technology that's essentially driving the on purpose. We continue to be in a world where if you're going to have incremental propylene, you've got to have on purpose propylene being built, and PDH has certainly been the technology of choice, especially in parts of the world where you've got available supplies of low-cost propane, a la Alberta. And so that's, from a standpoint of the propylene market, crude oil price will certainly be important, naphtha will be important, but on purpose and the propane dynamics certainly will be the important part. I will say this, as more naphtha cracking comes on, we take a little bit of the pressure off of on purpose. Not all of it, but a little bit of it in terms of the amount of on purpose that you may need, because we are bringing more naphtha cracking back into the fold. And so let me just summarize, because I am a bit over my time link here. So this strong demand, limited supply has been in driving this extended upcycle, this higher level of profitability, which is now being threatened by clearly some headwinds that are out there. And pick your headwind, from crude volatility to currency fluctuations, rising interest rates, trade policy mistakes, whether you look at U.S.-China relations, what's happening on the North American front in terms of USMCA, and now even Brexit. And there's a list that goes on and on, especially on the geopolitical front. So there are certainly some headwinds, but we think the market has strong momentum over the next couple of years. Can't say enough about sustainability issues. Being focused on carbon, water, plastics will in fact remain a top priority. And then I'll end with the comment about this change in mobility, the emergence of China's influence, the global focus of plastic sustainability, the new emphasis on heavy feedstocks. These will all be major issues that in many cases will start to change how we need to think about the industry going forward as we come into the 2020s. I'm around all day. I thank you for your attention. Again, congratulations to the association for such a great turnout. Happy to talk more about these issues throughout the day. Thank you.